Namaste viewers. Today we have Mr. Sandeep Tandon, founder and CEO of Quant Mutual Fund with us. Erstwhile, Escorts Mutual Fund, it was taken over by Quant Group, which is headed by Sandeep in 2018. Since then, the assets of Quant Mutual Fund has been growing leaps and bounds, and today they are at 5,500 crores, mainly because of their performance. It's purely performance-based drive. The AUM has gone up, and many schemes are way ahead of their benchmarks in returns, in terms of returns, and also as well as peer group. So, I mean, I am as much as curious to know the reason behind it as you are generally. And, sometimes I wonder, is it because of the bull run? Sometimes I wonder, is it because of the small AUM size they have? Or is it due to the research work and hard work put up by the AMC team? So to clear all these doubts, the best way is to hear it from the horse mouth, and hence it is none other than Mr. Sandeep Tandon, who is the founder and CEO, who is driving this organization from the front. So he is with us here. Namaste, Sandeep.
Namaskar.
Namaskar. And Quant Group is guided by two powerful mantras, being relevant and predictive analytics. These are kind of new words. Predictive analytics, for many of the viewers, it will be a new terminology. So we will hear more on these two mantras from Sandeep Tandon himself in a short while. Prior to founding Quant Group, Sandeep has worked in pivotal positions with ICICI Securities, Kotak Securities, REFCO, and Economic Times Research Bureau. Anyway, now let us get into it. Sandeep, for our viewers, if you can, tell us about Quant Mutual Fund and the story behind it.
Okay. Thanks, Mr. Choklu. I will just share a few slides, to describe the mutual fund and some of the framework which we talk about. So before just coming to, talking about these two mantras which you talked about before I talk about the mutual fund or AMC itself, see, like in life, everybody wants to keep himself or herself relevant. Okay. So that is the key philosophy, and keeping us relevant at all given point in time, it's not easy. So this is something, which we like to demonstrate. In last many years, we have demonstrated and would like to continue. So this is one strong mantra we believe, that you have to keep yourself relevant, which basically means that you have to adapt new changing environment and accordingly play this battle. That's the way we talk about being relevant. And second thing, when we talk about predictive analytics, we have been doing this analytics work for nearly 30 years. So Quant Global Research has been the existent right from 2007. Okay. I have noticed in my 30 years of career that a lot of people do postmortem work, when the event is over and then nice note will be released, this is what exactly played out. But that by the time market has already discounted these information up to large extent. And that's the reason we try to work on the concept of predictive analytics. It's very different from forecasting. Okay, so when we try to look at the much larger macro perspective and try to connect the dot and see what sort of picture is emerging, that's what we mean by predictive analytics. So it's a preempt in up to certain extent, but it is with the known facts. Okay, and how well you can connect the dots help me in forming opinion through our models called predictive analytics. At Quant Mutual Fund, we actually give a lot of emphasis in terms of what type of environment we are operating. It is very important to understand because every technique or tools cannot be used for the different environment. Since we live in a dynamic world and things are changing so radically, and that's the reason we call ourselves as a dynamic style of money management, basically adding alpha while subtracting beta. What it exactly means that we are big users of technology. Okay, we use machine, but decisions are taken by the money manager itself. Okay, and the most important thing, a lot of people also get confused with the quant name, whether we are just a quantitative house or algorithm based house. Okay, yes, quant is one aspect of that. So we look at the multi-dimensional approach, okay, where we combine the qualitative aspect, which is fundamental, the quantitative aspect, and the behavior aspect. Okay, all three things we combine and what we call it fundamental atma, liquidity, the prana, and sentiment, the maya. We try to capture all three things together. Okay, and we acquired this mutual fund from Escort in 2008, and we name as Quant Mutual Fund. So we bring the concept of multi-asset, multi-manager, because we have seen in last 20, 30 years of mutual fund experience out here in India, if one manager performance is affected, the whole fund is affected, because it's a one style of management. Okay, so we how to reduce this risk. Basically, the whole idea is to reduce human biases from the system. Okay, this we do through multi-asset and multi-manager concept, where one scheme is managed by three different philosophy. One is talking about valuation analytics, liquidity analytics, and risk appetite, which I'm going to touch base in next few slides. The whole purpose is that to reduce the risk. This is what we call a mint fresh approach towards the business. Okay. Now, since we talked about the quant global research also, so quant global research is one of the oldest research arm of this of quant group, and we have been operating from 2007 onward. December 2007, quant global research was formed. So this is all concept of how predictive analytics and let me just re-emphasize about the predictive analytics tools. So when we talk about multi-dimensional aspect and we look at all asset classes, so we talk about cross assets, cross market, basically anything which affects market globally, whether you talk about politically, a geopolitical volatility, you have to talk about, we're talking about earth changes or weather related changes. Okay, nowadays it's been fashion to talk about earth analytics, but very few people have able to quantify. Okay, people do talk about behavior aspect, the sentiments, but people don't quantify. So we have gone one step ahead. At quant, we quantify everything, including sentiments. Anything which affects market, we try to quantify, and that's the way it is a completely new concept we bring to the table, and it's an evolving form, because we are also learning on daily basis.
True, Sandeep. Because for if you are able to predict the natural disasters and political, changes, that itself is a great thing. I mean, many people struggle to do that.
And we have attempted and we have been very successful. I will talk about that. So when we talk about dynamic style of money management, I used to run a very large prop desk in this country with 380 traders in the past. Okay, and our style of money management is to preserve the capital, the way any bank's treasury or the large corporate treasury runs. That's the way we look at. So we try to combine both from near term, medium term, and long term time horizon. We look at both value, active, passive, or special situation, or any other combination. So as a house, we try to see as an opportunity. Okay, we don't want to constrain about this. I will not do that. I will not do. So any opportunity is there, we bring that flexibility and we try to capitalize that opportunity. That's the way we call it dynamic way of money management. Okay. Then I also talk about, let me show you a very interesting thing we talked about, So this is a picture of Wall Street where people have lost their job and people are just standing. And this is the ad campaign going, people saying that, quant is hiring liquidity analytics, volatility analytics, geostrategic analysts, cycle analysts, perception analytics, or climate change or geocosmic analysts, So what exactly it means that in next many years, Mother Earth will play a very important role. So we have already captured it through our analytics called Earth Analytics. Okay, how people look at the perception analytics. So we are student of behavioral finance. So how the perception plays a role. Like when we talk about, people say bhav bhagwan hai, So the prices are linked with the demand supply. But what drives the demand supply? Actually, the perception will drive the demand supply. How perception is created, we can drill down and I can bring multiple angles. So we run a complex multivariate model to create a perception analytics, okay, a liquidity analytics. So I'm just giving you few examples. So we have arms and ammunition to fight next decade battle. This is the way we look at, because the way the research will be next 10 years, all these traditional approaches of producing report will be over. Everything will be online. Everything will be online analyst, because with the courtesy the government, if the government start providing these online sales data, you can imagine how world will be, and it is moving, and digital has already played a big role. So this is what we are trying to showcase, how the future looks like. Now I will come talk about in terms of core belief of quant. Okay, and this is something which we talked about, the fundamental Atma, liquidity, the prana, and sentiment, the bias. Sentiments is very, very vital thing, but how you quantify? So we quantify sentiments through our risk appetite. Okay, that's the way mathematically we can do through risk appetite. And risk appetite is quite different from risk. So it's not the inverse of risk. Risk appetite, it's a reflection of your conviction level, confidence levels. Okay. When you are extremely bullish, your nature or the traits which you take is very different. When you're worried, or like, let's say example, I will take this example through a very classic, what happened in 2020, post corona. I think in March 2023, we hit a lower circuit. On 24th March, market was a lifetime, was a 52 years low. What exactly happened? If I have to convert into these numbers, the risk appetite was at 4 decades low. Okay. So it means in last 40 years, the risk appetite has never collapsed globally what it collapsed. Okay. And from then it was recovering. Courtesy central bank, the liquidity was anyway high for long period of time. From post 2008, we have seen multiple rounds of quantitative easing happening. So, and with this pandemic also, the global central bank work in a very cohesive manner. The liquidity was at lifetime high. Okay. And fundamental, nothing has changed in 2 days, and nothing can get changed in 2 days. The real impact of change in fundamental can be only felt after many months or many quarters. Okay. So now come back to the important concept of liquidity in Prana. Whenever risk appetite after hitting a lifetime low started rising and liquidity is at lifetime high, that was the lethal combination for a bull run. Okay. This is how we define from a behavior perspective. That was a lethal combination. And at that stage, we have increased our mid and small cap exposure significantly. One of the key reasons why we outperformed the market as was this, because we are able to understand the changing environment and we played that battle accordingly. So you have to know when you have to play on front foot and when you have to play on back foot. Okay. And this is one of the key reasons we believe that the environment is very vital. I keep on talking about the concept of adaptive asset allocation versus tactical or strategic thing. And in very simple layman's terms, you should know what environment you're operating. Okay. We try to gauge whether it's a risk on environment or risk off phase. And that's one of the reasons our churning and our portfolio is on a higher side. A lot of people consider this as a negative aspect. The churning is high. People don't know what is their strategy, what is their game plan. No, we change our portfolio based on the risk on and risk of environment. One of the reasons we have outperformed significantly that we were able to gauge the risk and risk of environment well, and B, we have played it quite well. Okay, so it's a
Sandeep,
these are all.
Sorry to interrupt you.
Yeah.
Risk on means you are willing to take risk.
Yes.
Risk off means you don't want to take risk.
Yes, absolutely right.
Okay.
So when we talk risk on is there, people play on, to a high beta name. When you are in risk of environment, people play through defensive route. Okay. That's what we mean through. So it's a very simple concept. When we talk about sentiments, we can quantify to fear and greed. We can say what level of capitulation, like recently when market fell. Okay, the fear index, quant fear index was second largest after in last 10 years. So it's really helped. See, when you make these data point, when you have a rational thinking, and when market is euphoric or like fear is very high, then you can really use these tools which you have built when you have a rational thinking. Okay, so
Good.
So next slide and the last from the mutual fund perspective, this is our investment philosophy: active, absolute, and unconstrained. So I talked about dynamic style of money management, absolute. Okay, so it is our endeavor to deliver absolute return. That's what when we talk about treasury style of money management, whole idea is to preserve the capital and don't take unwarranted risk. Okay, and we talk about unconstrained. This is very important. Like now, in our dynamic style of money management, we should be very flexible and nimble. So when we talk about unconstrained, we are style agnostic. Okay, we are market cap agnostic. We are sector agnostic. We are pure opportunist. Okay, whenever we see opportunity based on our predictive model, we are first to play. So we play on the inflection points of the market. Okay, a lot of people ask this question: are you a momentum trader? Are you a momentum investor? Answer is no. Okay, we are actually an inflection point strategist, and we are always going to be early in spotting the sector or stock, and we will also be early in exiting. So that's one of the reasons sometimes when markets see a euphoric move and we have already exited the counter, okay, we might underperform in that phase. Okay, but it's a cycle which you play. So if you're able to identify early and return and exit early also, somewhere in a larger perspective, it compensates you for that, and rather it gives me better risk adjusted return, because if I'm able to time the market quite well. If I am early, then I'm taking relatively less risk as compared to buying a stock when it's already rallied. That what people call it's a momentum strategy. We don't actually play momentum strategies. Okay.
And
Now,
you have not anytime fallen with what they call as value trap or growth trap, whatever. I mean, you spotted early, but it didn't happen for the next 6 months or 1 year. Was there a situation like that?
so far, we have not faced anything like this. Like I'll give you a small example in terms of it is like ITC is part of our portfolio in a big way. And it was a very classic value trap, like somewhere in 2013 or 15, it was lifetime high, was the most admired category. So we tried to avoid this value trap because we define every stock is like they trade either in the most admired category or they trade in the neglected territory. When you hit the stock is at the peak of the cycle, which is like where the greed or the perception is indexes or indicator is lifetime high. We call it the most admired category. That's the time to prune down. And when stock hit in the neglected territory, the if I have to call it the most hated zone, okay, nobody wants to even touch it. That's the time we try to identify these stocks, like how we recently spotted media sector 2 months back or 3 months back. We were like relatively overbought, and we have seen the news happening on the Z front. Okay, I'm
Sorry,
similarly,
Sandeep, which
yeah,
sector?
Z media sector, and you see
Media
how
sector.
what happened to Z is it is a known fact. Z is their part of our portfolio. So I'm just giving you from an example point of view, not to get into stock specific thing. Okay, how you're able to spot. So see, we look at much larger. Since we are student of behavior science finance, it is very important to play through behavior data. Okay, so that's the way we differ from what lot of other houses, which are more from the traditional or statistical measure. Whenever you say P is below certain thing or the valuation multiples are below certain level, you call it value, and below that, above that is very you call it expensive. That's not the way we define it, because every stock, every asset class goes through a behavior cycle of admire category and neglected territory. So we are try to capture when it hit those classic inflection points. Okay.
Okay.
So we talk about our investment principle, measurable, reliable, that we say quant, everything has to be measurable. Either you are right or I am right, and result comes at every day at 3:30. So so it's a concept which bring to the table that it has to be reliable, it has to be measurable. That's what we do. Fundamental investing, it's all about how well we can combine fundamental along with the sentiment. That what is a concept globally is evolved on the fundamental side. I explained the concept of multi-asset, multi-manager, and the relevance. We talked about money flow analysis. Now let me spend a minute on money flow analysis, the most important concept which we work on it actually. So how you look at the energy never changes, it's never dies, it just changes its form, hydro to mechanical or mechanical to electrical. Similarly, it is not fair when we say that market cap, people write in the front page news, so many $1 billion of market cap wiped out, or so many in globally or or region specific. So what we believe, the money actually flow from high risk to low risk environment. Okay, you have gained something, I have lost something. So one asset class has gained, other asset class has lost. So when you look at in a total, in the combination, this is something which I have been from early stage, I'm trying to work out. In last 30 years, I have tried to resolve this or demystify this biggest mystery, how money shift from one asset class to other, how the time cycle plays a role, how the perception analytics plays a role. Okay, and it's very important what type of investor gets capitulated at the bottom of the cycle, or what type of retail investor gets stuck at exactly at the top of the cycle. This is something we call it money flow analysis, and we look at this money flow analysis from a global perspective as well as sector perspective and the stock specific. Okay, and the last important
Sandeep, to explain to the subscribers, it means whether the money moves from equity to bonds, bonds to gold, gold to other metals, something like that. Am I
yes,
right?
absolutely right. And similarly, how money moves from IT sector to pharma, or pharma to capital goods, or capital goods, because ultimately money is limited. Okay, you have limited money. Either you will buy a few equity schemes or few stocks, and you keep on rotating depending on your analytics or the recommendation which you are getting. Okay, so that what is called money flow analysis. When I see, so we are able to spot the money flow in early stages, then you can, and if your money flow analysis reading is right, and then you combine this data with the risk appetite, combine this data with liquidity, this is a deadly combination. So you will try to identify a sector first. So we are a very macro house, so the sector comes when, let's say we spotted a sector, let's say for currently a capital goods space, money flow is increasing, And then we say the liquidity towards that sector is also rising. Risk appetite is also rising. This is a very deadly combination that one has to go long in this particular space. This is exactly the framework which I'm going to talk about. Okay. Sure. Timing is everything. That's the last thing, this is the biggest myth in the market when people talk about never time the market. Nobody can time the market. One should never time the market. I think this is the biggest myth. Okay. And I'm very vocal, and that's the reason we are writing as an investment principle. Timing is everything. Okay. Why timing is everything? Because every trader, every money manager, every investor, and every business house wants to time the market. Okay. We always talk about right place, right time, So timing it's so deep rooted. Actually, it is there in your subconscious mind, but you don't want to accept it. As a house, we are very vocal about it. Mm-hmm. When timing is not about trading, when I talk to showcase this concept, I'm elaborate a bit more through a VRT framework. Why timing is very vital? Because timing actually reduces your risk. Okay, if your timing is right, you have less pain point. This ultimately is a psychological game. It's like in early stages. One paper goes for a toss, then other papers. When you was in school, is also affected. It's a psychological thing. Okay, if you can play it right and time it better, you will have a lot of peace. Okay, and rational thinking is not destroyed. This is what exactly when there's a big chaos on the street, and chaos is there, the rational thinking is missing. And if you can time it better, it solves a lot of problems. So I'm going to talk about this thing, and it's nothing to do with the trading. It's a much deeper concept. Okay, so now if you want, we can come away straight away to the our VLRT framework. Should I start, or you want to ask any specific question and before I move to the framework?
Yeah, you can move to the framework. Before that, generally they say like as I see, you are against the traditional fund management style, I would say, or you are bringing a new approach. If I say if it is not against, you are bringing completely a new approach.
Yes, that's a better way, because we are not against. Okay, because traditional houses looks only at the valuation aspect. Okay. And the bottoms up approach, only valuation, and every other thing which is not part of the valuation, it is considered as a technical. That's not the way we look at. Okay, if you meet any economist, he or she will tell you based on her data or his data, he'll say this is my fundamental data. If you meet a currency trader and he talks about global macro, he will talk about this is my fundamental data. Okay, similarly, you meet let's say a risk appetite strategist or liquidity analyst, these are say this is my fundamental data. This is not technical or charts, because some of the thing when people don't understand, they try to demean is all technical. Okay, we don't follow that. Okay, our belief is that there are new things which is evolving globally, particularly in the behavior side, on the quant side. Okay, and we should be adapter of those technology rather than those concepts, rather than saying that I don't understand, so I don't believe in these things and these things doesn't work. Actually, it worked for us. Okay, this is something which I'm going to showcase why one of the key reasons where we got a massive outperformance within the industry is by just following and learning these things. We have built incorporate these data points through a framework which I'm going to talk about. Okay, so we talked about predictive analytics. Okay,
And one more thing, Sandeep. Say like irrespective of the asset size that you will be managing today, say like you are at 5,500 crores. Tomorrow you become a 1 lakh or 2 lakh fund house. 1 lakh crore, 2 lakh crore fund house. So still you will be able to do these things. Am I right?
So, Mr. Choklam, you are absolutely right. We are very confident about doing it because our strategies are very scalable. Okay, this question was asked when our small cap was 1 crore rupees corpus. This question was asked when we were 50 crore. This question was asked when we were 100 crores. This question was asked when we are 1,500 crores also. But you have seen that we are able to maintain the outperformance part. Okay, and what is very relevant to understand that strategies are scalable. But stock selection methodology will change as you get a mandate. If your size moves up, we'll start giving more weightages on how you look at the impact cost data on a regular basis. And you also keep in mind there are other techniques, other products available. Let's say talking about derivative as a product. So if I have to buy, let's say a million shares of some names, I can participate the same stock through derivatives route initially, okay, because the impact cost and derivatives is so low as compared to cash market. So it's another product which is available. People have not used it, and I was one of the biggest user of that play, because I used to run some of the derivative desks in the country, the largest market share. So we understand that space very well. And third most important aspect is that keep in mind, as we grow, Indian market is also growing. Okay. Now look at the way the market cap is growing. New stocks are coming. 1 lakh crore got listed, got taken away from the primary market. This is the size. So Indian market size is also expanding. Number of the market, both depth and breadth of the market is also increasing. That will actually help us when we grow. So I think these strategies are very, very scalable.
Yeah, I agree. One more thing is,
this is another myth which people talk about. The small size you can do it better, the bigger size you can't do it. This is another myth we should try to educate people.
I understand. The second thing is, the one more thing is, you in equity mutual funds, direct equity, 100% equity mutual funds, do you use any derivatives, or it's all physical shares generally? I mean, in the sense, direct shares.
So far we have occasionally we have tested some of the trade. We have not used in a big way. Okay. But we have a flexibility from our SID and even from SEBI approval. We have taken, technically we can hedge 100% our portfolio if required. So far there's no need, so we have not used it, but we have that flexibility and mindset also to optimize it if it is required.
Okay, sure. Please go ahead with the framework.
Okay, perfect. So when we talked about predictive analytics, is a very interesting thing, how well you can quantify and fear and greed. Okay, let me give you a very small example. When we talk about, you can say, yesterday I was very angry. Okay, only your family members or your close friend circle can tell you that you are really angry. Okay, but they will not be able to quantify the level of anger. Okay, but if you are a market participant, okay, your fear and greed is reflected in your price action. What is the urgency of buying something? What is the urgency of selling something? Okay,
true.
I cannot measure your fear and greed of an individual investor, but in the market, with the help of secondary and tertiary derivative, we can actually quantify the fear and greed of particular country, or particular asset classes, and particular segment or particular sector, because cumulative fear and greed we can quantify, because it is your action is actually reflected in the markets. Okay, when you were angry, it was confined to your family or friend circle reaction. Okay, but your fear and greed it's reflected there because you are participating in the capital market in some way or other, and with the mathematical models or the predictive analytics tool which we have built, we can actually quantify these things on relative basis. And that is something which we talk about predictive analytics. So basically it's a very simple terms, when we talk about global aspect also, how you quantify and fear and greed for the global asset classes. So basically it's a complex subject, but in a very simple terms, we can capture these through leverage route, through credit market, and through volatility market. If you combine, this is our trinity, which we call it, So with the help of that, we can actually quantify. I'm not getting into complex mathematical aspect of this, just for the simple explanation point of view. Yes, you can quantify. It's not easy, but you can quantify.
Okay.
Let me come to now our framework. Okay. It's a very interesting thing. And like at quant, I said we quantify everything. Can you quantify future earning? A lot of people can do it. Answer is yes. Can you quantify valuation multiple? This is a big mystery. When every research houses makes its reports and talks about, next 3-5 years projection in terms of bottom line or top line or revenue or cash flows. But nobody quantified what is the fair valuation multiple. This is where I consider them, every analyst play as a if you have to call it, it's a balancing number. If you want to change your multiple, you change them. If you change the price target, you change the multiple, and the price charges get changed. And actually, this is where we have put in serious effort. It's easy to criticize, but what is the solution? So we have tried to create a perception analytics, which I was explaining in the beginning. With the help of perception analytics, I can quantify irrespective of what is the valuation multiple, whether it's price to book or price to sales or any new complex valuation multiples are also evolving now. Irrespective of that, in a very simple manner, we can quantify the valuation multiple through a perception analytics. This is something which really help us. Okay. And I'm going to talk about more when we talk about the market outlook. Okay. So can we quantify fear and greed? Answer is yes. Can you quantify fear, risk on risk of quantum as well as face? Answer is yes, we can quantify. Can we quantify global liquidity? Answer is yes. Global liquidity is far deeper concept than what you see in the FIS number. A lot of people look at what is the mutual fund in the FI number in the evening. That is liquidity. That is one part of a liquidity. Is much deeper concept and is an even broader concept than the money supply. Okay. Can you quantify risk appetite? And risk appetite is different from risk. Yes, we can quantify. You can also the concept of known risk and unknown risk. At least known risk we can quantify. Okay. Can you quantify geopolitical volatility up to a certain extent? Yes, we can quantify. Can you quantify the impact on the earth changes and how, let's say small example, how magnetic fields affect economies and in turn affects markets? Okay. That is something I can talk for hours on that subject. Yes, it makes sense how magnetic fields affect. You'll surprised to know that we have been, as a student, we have been school days, we used to talk at North Pole is in Canada. You'll surprised to know that North Pole is already shifted to Siberia. And what the changing in magnetic field affect us? It affects us in a big way. This is one of the reasons we are saying that Russia will emerge as a new superpower, and the relevance of dollar, relevance of US, and relevance of Fed will decline going forward. It has a lot of things to do with the magnetic fields, which is changing. We talked about the concept of money supply, how money flow can be useful for stock sectors or the asset selection. Now I'll come to the straight away to the framework which we talked about. Okay. And it is very important to, since I have already explained you about the concept, how multi-dimensional approach we are bringing. So we call it, this is a framework called VLRT. Okay. V is for valuation analytics. R is L for liquidity analytics, R for risk appetite, which is sentiments, and T is timing. Okay. When all three types of analytics, valuation analytics, risk appetite, and liquidities are skewed on one side, it result mean better timing. Okay. So timing is actually a function of other three analytics in very simple terms. Okay. And so timing, don't confuse with timing with trading or timing with, punting in the market. A lot of people say, oh, timing, we should not do it. And actually everybody wants to do it, but we do it through mathematical models. Okay. It's not our gut feeling that I believe, say, a lot of people make statement, I believe, it's my view, my experience tells me. Okay. We don't have any view for such things. Okay.
It is not intuition.
No intuition.
Okay.
No intuition. Okay. It's about either you convince me or I will convince you, and I will convince you through my numbers. So this is what we debate internally to my team also. Okay. Quantify it. Don't talk, I feel so, I think so, that there's no relevance for that in the markets. Okay. So it has to be quantified. So when we run a complex multivariate models, then it's a time we combine. So we also talk about the complexity. The more the complexity, better the selection, better is the outcome for us. Okay. Because the sample size is right. So we are very much interested in any new data points come. Let's take example, cryptocurrency. A lot of people, 99% people don't even understand what is crypto. Okay. Only young generation understand and they trade in that. Okay. Because they are making money, so they're trading. Their own understanding is also very limited. But we use crypto. I'm also not a trader of crypto, but we use crypto or the digital currencies, all the DLT framework in a big way, because that is the very classic risk appetite indicator for the next generation. Okay. So it's an important data. Like in the past, we used to talk about junk bond index as a risk appetite indicator. How your yield spread became as a risk appetite indicator. So like, how market has evolved. A lot of people are still stuck with the yields differential only. Then we move to the next level by looking at the new thing which is coming and try to incorporate in our model. So this is the way how multi-dimensional approach works beautifully. And this I talked about, like, let's move to the next slide. And when this is very interesting to show this data. So like we keep on hearing in the market, from the very eminent people sometime, valuations are expensive or valuations are very attractive. Somebody comes and talks about, oh, last year we missed out this rally because it was a gush of liquidity. So fundamental, nothing has changed. The liquidity parameter changed and it was a gush of liquidity which has driven the prices. Last 2 months, we are saying, oh, sentiments have turned bad, market has corrected, sentiments are not good. Okay. So, and do you have answer for any of these things? These are like very postmortem analysis. The event is unfolded. People make these statements. What we try to showcase how well we balance our portfolio through a VLRT framework is actually explained quite well. And this is a clock and the rupee symbol is there. Sometimes you see a cracks here. So, valuations are becoming expensive. So he's trying to balance with the risk appetite. We're trying to rebalance, and with the help of liquidity, we are further rebalancing. So it's not like everything is perfect all the time. Okay. When valuation becomes stretched, you have to prune it down somewhere. When risk appetite is very large, you have to expand your exposure to high beta names. When your liquidity is very large, you should not sitting on the cash. Okay. So it's a game which we play through this framework. Okay. And it is represented through a watch or a clock. Okay. Because it gives you bring the angle of timing. So timing is everything. This is the best way we demonstrate how 4 elements in motion work together. Okay. It's a very nicely articulated picture, where people try, because it's a balancing act. It's not like, when valuations are stretched in one particular sector, it's a time to prune it down. Okay. Because we don't have a mandate to show, we have best quality names in our portfolio. What we have to deliver, we have to generate alpha with limited risk. Okay. If risk is, because if it's speaking out, a valuation says that means the risk is also rising from the current level. So you have to move out. And risk, a lot of people look at the traditional approaches of beta value or standard deviation. Okay, those are very elementary concept of risk. We when we look into much deeper thing, then I'm not getting into that, but that's not the way we look at traditional approach, because it is not well quantified through these tools. Okay, so we look at much deeper concept on the risk and then try to evaluate that. Okay, this is something which is very important to understand that.
Sure.
And so I think the floor is open for question answers.
Yeah. Now you explained very clearly, in crystal clear, your thought process and all those things. I have some questions for you.
Yeah.
One is the market outlook for the next 3 months or next year, or in the longer term. If you would like to share what is your thoughts, as you are mentioning that US may not be a dominant player in the future. So some of those things.
Okay. So let me just correlate what happened in March 2020, since the biggest bull run started and where we are right now. So I'll give you a small example. I said in the beginning that in March 2022, 20, the risk appetite from low level was inching up, liquidity was lifetime high, and the lethal combination for bull run. So our entire portfolio from May onwards was skewed towards mid and large name. Now let's understand where we are today. Okay. By 2020-21, okay, the global liquidity has peaked out. It started drifting down marginally, both good and bad liquidity. If I have to define, whether in terms of bad liquidity is the government liquidity, the central bank's liquidity, that what is called good liquidity is meant from the productivity of the private sector, which is reflected in GVA, so free cash flow, various names you can look into it. Okay, it's a good liquidity which is there, and good part is India, good liquidity is rising. And then try to look at the risk appetite. The risk appetite is also peaked out in certain market, like in China, it peaked out in February 2021, and you see how Chinese market is corrected. This has a very classic linkage with the risk appetite. Similarly, most of the risk appetite data for global countries or equity as a whole has also peaked out. It's marginally dipping down, but liquidity has come off, but still there is an ample liquidity. Okay. Now let's look at the money. I'm giving example, all concept we talked about, money flow analysis. So let's focus on equity money flow analysis from a global perspective. We have seen in the month of September, the equity money flow for global equities was at multi-decades high. And since then, it started drifting down. Okay. And if I have to conclude two important conclusions, are we in euphoric phase? Answer is yes. Okay, though we have seen small correction, but we are still in the euphoric phase. Okay, can this euphoria can last for a few more months? Answer is yes, it can last for a few more months. Okay, so it is very difficult to time the exact top. Timing of the bottom is still easy, but timing of the top is not easy. Okay, because in top it takes time to distribute, and panic happen and you get capitulated and you surrender your position. So bottoms are making very quick reactions comes when you bottoms are placed. So now you talk about let's what we have to conclude. The two important conclusion we have to draw. If it's a euphoria, then if you dissect this euphoria into, like, let's talk about MSCI World or FTSE World and try to dissect this uh, perception index or euphoria, which I'm talking about, which can be measured through multiple behavior data points. In a very simple terms, either you look at the sector dissection or you look at a very simple value in growth. Okay, so when the moment you see growth, then you see that growth area is the where euphoria is getting built. Okay, and value is the area where it's still in the early stages. So if I have to really conclude, if it is euphoric phase, there's euphoria is this growth stock, not in the value. So I will prune down my growth stocks from my portfolio and I'll increase value stock in my portfolio. This is one simple conclusion. Second most important conclusion is that when risk appetite is declining, liquidity started inching down. It is exactly the reverse of what happened in March 2022, which means we are in the fag end of easy phase of bull run. If you ask me, if I have to conclude, we believe that easy bull run is already over in September 2020. Easy phase of bull run is over. But I'm still using the word we are still in bull run. Okay, that is very important to understand. We are in bull run, but now we are in difficult phase of bull run. Like if I have to go back and give you some example, India, like when we used to write our strategy piece, so in August 2012, we have written 100% return in 100 weeks for three markets: US, India, US, India, and Japan. It happened between 76 to 104 weeks. So August 2012 till August 2015 was the easy phase of bull run, where stock multiplied. From August 2015 till December 2017 was the difficult phase of bull run, though it was still a bull run. Okay, and then January 2018, we noticed what exactly played out. Okay, so this is a cycle we look at with the help of multiple analytics. We can quantify through predictive analytics model. We can visualize how the picture is getting built right now. So easy phase definitely over. Okay, what is more important to understand from India perspective now? In last many years or last 10 years, it was the bull run in US market and the developed market. Okay, and if I dissect this thing on the developed versus EM, then we say there's a more euphoria in the developed market than emerging market, which I will link the risk appetite and liquidity, because the risk liquidity indicator has peaked out in US and developed market and Europe, where in Asia it's still rising. Okay, risk appetite is India and Asia, including China, is on lower side as compared to developed markets. So in next 10 years or 8 years now, for the current decade, another 8-9 years, I expect that money will shift from developed market to emerging market. And within emerging market, it will be more towards Asia-centric emerging market, and within Asia-centric, India will be the biggest beneficiary. So we remain very constructive for India. If I have to bring down Indian macro, we believe Indian macro are the best in the world, given the volatile environment which we are in. Okay, we remain very constructive on after many years, maybe after a decade, we as a capex cycle is coming back in India, and capex cycle has multiple derivatives. Okay, so if capex cycle comes back, multiple sectors moves up. Okay, and hence by default we can say the mid and small should be also beneficiary of that. Okay, but two important conclusion if I have to make for India. The investor has to prune down their expectation, whatever return they have made in 2020-21. That those were like exceptional years and people have made extraordinary profit. That should not be the benchmark. If that is the benchmark, then people will get frustrated, and then it's a game of a psychological number. You know, I got 80% return, now I'm getting only 20% return. So it's a big disappointment. So I think the expectation has to be brought down to irrational levels. Okay. Yes, we are in bull run, but we are in difficult phase. 2020 will be very, very volatile. So we have been talking about right from 2018 till 2023, based on our predictive analytics model, it's a most volatile phase. We call it volatility expansion phase. Okay. In volatility expansion phase, your traditional techniques of buy and hold strategy will not work. And this is what happened not only in India, globally. Long accounts, traditionally long accounts, mutual fund have losing market share and they don't figure in top 10 also. Okay, it's a very clear indication how the relevance of environment plays a role, how the relevance of adaptive asset allocation plays a role. That's the reason we are strong believer of understanding the macro environment first, what environment you are operating, then select the strategy. So people who are using the traditional approach of buy and hold because it worked for many years has not been effective from January 2018 till now also. Okay? And it will not be remain effective, at least with our analysis till 2023. Maybe in 2023, our predictive analytic model suggests something has changed and you also had to adapt, then we'll adapt. We are flexible. As I said, we don't have rigidity. It has to be get endorsed by our models, not with our my view. Okay, this is what I think is played out. Okay. And we are also living in a dynamic environment, so it keeps on evolving. That's the reason when we say we keep on adjusting our portfolio based on the environment. So 2022 will be more volatile, much more volatile than 2021, and hence your churning in our portfolio, you will see, will actually increase. If I have to generate extra alpha, I have to prune down my expectation. I have to prune down my cycles. Okay. I will not say that, okay, last year I was holding for 2 months or 2 years, I will make good money. So as on risk, and that's the reason when I say the cycles will be smaller, if markets are more volatile, the risk on risk off cycle will be much more smaller. And you should learn to how to make this volatility is your best friend. Okay. A lot of people are worried about volatility. We will say, oh, volatility is very high. I'll let it settle down. Let this settle down. I'll buy 20% higher. I don't mind it, but I don't want to participate now. That is the wrong way. Okay. If you make this animal, okay, this difficult or invisible animal, what I call as a volatility, make your best friend. Trust me, it will give you a lot of peace and it will give you a rational thinking. It will be able to retain your rational thinking. This is what exactly what I see in the behavior science. Okay. People get disturbed. Okay. When people talk about market 10-12%, if you tell the market 10%, which is very healthy, but when it happens, the health of the most of the participants get affected. Okay. So when we talk about it is healthy, but you can't manage, and people actually give up exactly at the bottom of the cycle. They surrender. Okay. And this is what we see in our euphoria indicator. People tend to get euphoric and their conviction level is high. This is the time where risk appetite dies. And we quantify these things to numbers. Okay. This is not just imaginary numbers, yeah, this risk appetite is how high or low. We actually demonstrate through our graphical numbers. Mathematically, it can be proven. This is what numbers are there. And again, there's no relevance of, I'm a student of theory of relativity. Everything has to be on relative basis, nothing on the absolute numbers. There's nothing, no concept like absolute works. Okay, everything is relative in life. Okay, so on relative basis, if you can do a good maths, these are mathematical numbers which can. So as a student of applied maths or applied economics or applied stat, you can actually quantify these things. Okay, so it's very important to quantify that. Go ahead.
So if I can sum it up, 2022 next 12 months, you are foreseeing that there could be more volatility, and probably we might be still in a bull run. I mean, there may not be any big market crashes in 2022.
So I always said, like, and 12-13% is a very good correction and a healthy correction. So let's say whatever 18,600 or whatever, so it comes down to what 16,200 or 16,300. That was the ideal level market should have corrected. It came closer to 16,422 odd levels. And so it came very close to the numbers which we are working with that. And it has moved up since that. But I can tell you, a lot of people are asking this question, whether market has peaked out, whether small has peaked out, mid has peaked out. This is the biggest worry because a lot of people are now stuck at higher levels. So I don't know about every stock, but I can say with good amount of conviction, in India, we have not seen the long-term top. There is no signs of any classic top which happened in 2008 or 2000 or Harshad phase of 92. We have not seen a classic euphoria in our system as of now. Okay, which means you will see new high in the market as early as 2022 itself. Okay, and if it happens by March 2022, also don't be surprised.
Oh, okay, very good. So I was what you are saying is correct. One of our customers from Belgium, I was talking two days before. So he has put in a world indices fund, ETF, whatever. So he has more cash. He's ready to put, but he's worried that a depression like Japan or a depression like US, what happened like the 5-6 decades ago, or in Japan 2-3 decades ago, will it happen? I mean, long depression in equity markets. Will it happen in India or else? That was his worry, one of the worries.
Not at this point in time. India is very uniquely positioned at this point in time.
Good, good, good.
And this is what the beauty of numbers. I'm a student of maths. When you get into mathematical thing, see, everything is quantified in the world. Okay, everything is quantified. Okay, when you get into that and you realize there is no science on top, that gives you peace. Baba, koi top nahi hua hai, let's chill. A lot of people actually create more problem with that anxiety. Oh, I have missed out. It looks like I have only made the top.
Yeah, yeah, no. Indian market is good to go for a long time. And within your fund basket, what would be an ideal category to enter now? It's a multi-asset or hybrid or equity for with the investment horizon of 5 years and more.
So I think it's obviously depending on the risk profile of any individual investor. We always recommend like active is the relatively well diversified, it's a flagship and product for us. We say if you're a new investor you can go for active. Okay, if you're willing to take more risk, okay, and this you said for 5 years, then go for thematic thing like we recently launched a value fund. Okay, so we believe next few years belongs to value. We like infra as a theme. So in quant infra fund actually is one of the best in that category. In fact, the fund has given better returns than the technology fund in the industry. So infra fund is one of the highest return in the sectoral themes. Okay, so but we like capital goods as a theme. We like infra as a theme. When globally this monetary stimulus have actually failed. That's the reason I say the relevance of Fed and relevance of central bank will disappear in many years. Because when 2008 that quantitative easing started, we thought it would be just one-time event, But since then, we have last 13 years we have seen 5 QE, and maybe till 2027-28. That is our model suggests that you will see multiple rounds of tapering and multiple rounds of easing. But the long-term interest rates and inflation will remain elevated. Like right from 2019, we have been talking about that from 2021. Interest rate was right low for long. That was a thesis people used to talk about. I think cycle is up. So you have to make your portfolio in such a manner that you should not be impacted, or your portfolio should not be dented by these concerns, which are not transitory. Our view is inflation is not transitory. I think the structure is going to create a havoc globally, particularly in the developed markets. I'm more bearish. That's why I said the beginning. I'm relevance of when I'm raising a big question, the relevance of US, and this is a time where everybody is talking about technology funds and talking about US centric fund or Nasdaq funds. This is not the time to go out in these names right now. Right now, emerging market value or India as a theme will actually deliver better returns.
Yeah, yeah, true. But because the last 10 years, I think I agree with your viewpoint, because the last 10 years, the US technology stocks or the US market or even Chinese technology stocks, whatever, when they put the name technology, it has roared like anything. And the dollar terms, I'm seeing some 24% CAGR, all those things. So probably it has to somewhere settle down. That's correct. And yeah, you shared your thoughts on the international markets, and you were precise that saying that technology and other things may not be the area to going forward. Probably emerging markets will do a better job, and Indian market will do a better job. And when do you think the interest rates will start moving up?
So I said we are more concerned about developed market. I said that till 2027-28 interest rates will remain elevated. Okay.
Wow.
Okay.
Okay.
So both interest rate and inflation, and when you are in fiscal stimulus, so commodity prices rallying and interest rates moving up is a byproduct of that. So it's bound to happen. But I am not that bearish or worried about India, because Indian market data is very limited. For me, it's very easy to quantify about US interest rate cycles, okay, as compared to Indian interest rate, because the data is limited and the options on which we derive a lot of derivative data is not available in India at this point, because there's no liquidity in that. So if I have to say from 2020, I'll say the 10-year yield should be between 6.25 to 6.75 sort of zone. So it's not anything very meaningful which will happen in at least in 2022. But as we said, we all live in very volatile world, and as data changes, we'll change our opinions. And as we are not married with one particular view, because it's a data-driven house, data is God for us. Okay, so data changes, we change our view. Okay, yeah. But as this point in time, if you ask me, this is the what view which is emerging for debt market as a whole. And this is one of the reasons we believe this is not the, even in 2022 will not be a year for debt market the way it has happened in 2021. Okay. uh, on relative basis, emerging market will do a better job than developed market, and so is the case with the, let's say if the Indian bonds are part of the global bond or the emerging market bond index or global index, you will see good amount of money flow happening, okay, which has good amount of positive impact on the currency as well. And more important is the sentiments. Okay. So I think it's a very range bound move at this point in time, but typically we do our work in the beginning of next year
Correct.
and try to form opinion on.
Sure. And how about China? China is, people are saying it's all-time low, and from there, is there a chance to pick up or still will worsen? Any thoughts you have?
So the way we look at China right now is that if you read our book, The Being Relevant, the book which we have shared with a lot of people, we have talked about that China is the epicenter of the crisis. In 2022, 20 till 2030, you will see one of the biggest wealth destruction plays globally. But need not be worried about, if you can play your cycle right, actually you will make a lot of money in this space. Okay, because as I said, we have already made volatility as a friend, so we actually thrive. If volatility is very high, it is actually good for us. So my view is that we have seen a sharp down. So I think possibility of up move is there. They can recover from the current level, but within Asia, we remain very skeptical about China. Okay, we think money will move out from China. Risk appetite is declining, and one very important thing is, and based on our macro thesis, is that China is trying to emerge, trying to replace dollar as a reserve currency. At least they will try to do in the Asia first. So their strategy, everything revolves around the stability on yuan. Okay, and that's the reason you have seen last 1 year yuan is very stable. Otherwise, yuan never used to be so stable. The stability of yuan will endorse their uh, claim of a reserve currency status. So China will do everything to ensure the yuan stability, and that's the reason they are least bothered about other moves which is happening. A lot of people say, it's very destructive what they are doing, but I think China is a very smart animal. They are very smart people. They are strategists actually. So whatever they are doing, they have much longer horizon what they are doing currently. So given the background, I'm not going to be participating in China in any manner. So even this will be a pullback rally, maybe from second half of 2022, I think very difficult time for China to start. So I'm very, very bearish on China from a longer term perspective. When in the wealth destruction phase, I have talked negative about China, and we said highest level of bankruptcy you will see from China in this period. One we have seen very recently, though this book was written in 2019. And you will see when wealth destruction phase happens now, it creates lot of problems. Okay, so it has its own challenges. So I am as an investment destination, I will like to ignore China completely.
Taken. And when the developed markets raise interest rates for the next 6-7 years, does it mean gold prices will shoot up?
So, as I said that we are living in a very volatile environment. No moves will be very linear. Yes, we remain very constructive on gold. Like 2020, we were very in 2019 till 2020 was very, very constructive. 2021, we say silver will outperform gold. So we are optimistic on precious metal space as a whole. But again, I'm repeating that in a volatile, so that if it's not like the interest rate will move up one way up, you will see one leg up, one move leg down, maybe two leg up and another move down, because central banks cannot afford. Okay, if interest rates moves up the way they are proposing and the way market is reading, or the way used to be normally earlier used to happen, then multiple countries will be wiped out. Okay, the debt levels are so high. Okay, so there will be reluctant to increase the interest rate. That's the reason I'm saying the time cycle goes up to till 2027, 28. Okay, and I have been very aggressive. I said whatever the low you have seen, it will be interest rate will be as high as 6 to 9 times of that number. From 1.2, that level of interest rates, inflation is coming, and I think there I'll bring the natural crisis are knocking our doors. Okay, this is the phase of deglobalization. So we have said that 2017 till 2047 is the global reset phase. Okay, we have written in our January 2017 report, it's all about active strategy going forward. It's 2017 onward, global reset phase begins. When we're talking about, and that's the time Trump has not even taken the oath, okay, when we talk about deglobalization, okay. So we are in deglobalization phase, global reset phase, and that will go up to till 2047. That's the way we say relevance of dollar will not be a reserve currency status by then. Okay, but it's going to take time. It's not going to happening overnight. And I think the earth changes will play a role, because let's talk about concept of global warming. Everybody talks about global warming, and global warming is coming. According to our analysis, Earth Analytics says that global warming has already peaked out in 2018. We have already entered into what are the phase we call it cold and wet phase. Okay. And when you are in this cold and wet phase can last up to 2040. Okay. And 2020 till 2030 will be the most disturbing phase of the Earth Analytics. Okay. And this is that when you talk about cold and wet phase, it means the productivity and efficiency of many countries, including US, Canada, even Europe, even Latin America will be affected. So when we're talking about crop cycle, let's say in 2018, US, both corn and soya crop yield was the highest. It's not because of winter countries. Because of global warming, their crop yield was on a higher side. And if the temperature cycle is changing, and this is not my data, is based on NASA and a lot of scientific journal which we read, okay, it is that phase has already started. Okay, when market and global certain countries, certain zone becomes much more cold. Look at what happened in Texas very recently, what happened in China in 100 years. We have never seen that sort of flood. So people used to talk about next battle will be fought about water. No, we have enough water. People will be worried about water levels will rise actually. Okay, everywhere. Okay, and this is what we have seen, glaciers are melting down. So I think Earth Analytics is the game, okay, which people have to look at.
We are seeing in Chennai water levels are going up.
Correct.
Now, earlier, newspapers used to write an article that for borewell, one has to obtain government permission, all these things, don't go for borewell. Nowadays, the same newspaper, they are writing article, everyone should put a borewell so that water can be taken out and level will be available for future rains.
Correct. See, this is something we call it predictive analytics. If you can see how future will unfold based on connecting the dots, it's a very scientific way of doing it. It's not like we are astrologer and going to talk about that. It's a scientific thing. We capture these things, so it's a very interesting space.
Good. So that is good. I mean, there is positivity towards gold. That's what I can take it from you.
I'm positive. But don't expect extraordinary returns from gold also. So it's not like people say, oh, I'm very skewed towards gold. You play the cycle. As of now, precious metal outlook is positive. Because next 1.5 years, this inflation noise will only rise. Okay. Maybe by 2023, I expect this noise will be on a higher side.
Okay, sure. And your quant mutual funds future plans, if you have anything you want to share in a minute,
So I think it will be our endeavor to complete the bouquet, for various schemes, which is like, whether it's a thematic funds or some of the large caps sectoral funds or even large cap funds, or some other products like BAF and other, which is not part of it. So we like to be a complete. We are not very we say just want to focus on few areas. We want to offer complete bouquet to our investors. So we'll be completing those things because it's a new fund house and it takes time to complete that. So that is the first endeavor.
Sure. Definitely. Your advice, anything for investors, you want to say something?
So I just want to repeat what I said earlier. Expectation level has to be rectified. That's the most important thing, because it's a psychological thing. If you keep expectation level high, you will be frustrated and then you will tend to make mistake. Second most important thing is that you have to accept, most of the investor has to accept that we are living in a geopolitical high volatility phase. Equity volatility, even let's say from the VIX perspective or the bond perspective, every asset class, every financial asset class will be more volatile in this phase. Okay. And hence we should not get too much worried and tense about volatility. Rather, I said that you make this animal as your friend. Okay, invisible animal as your friend, and try to capitalize on the short-term cycle rather than getting worried about it. You have to adapt this. Okay. If you can change your mindset, okay, that will give you a lot of peace. Okay. Because you are mentally prepared. So I'm not trying to, a lot of people say, oh, 2020, 30, you have written so negative about, wealth destruction phase, then you are launching your own mutual fund in this phase. Okay. So are you contradicting that? Okay. So I said, say yes and no both. I just want to give you perspective how this phase will be. Like in 2012, we talked about 2020 will be meltdown phase. It's turned out to be true. To writing something on predictive analytics in 2012 that 2020 will be the meltdown phase and bubble will burst. This is what we have written actually. How currency market will play out. So I think the way I look at this, I think I'm a very clear opportunist. I will play on this cycle. Okay, if my volatility is on a higher side, I'll prune down my exposure. When it comes down, or maybe peak of the cycle, I would like to add. So you should learn and change your traditional approaches. Okay, if this mindset of buy and hold has to be changed, lot of myth has to be broken. Somebody does churning is bad, somebody do sector rotation is bad, somebody buy, a lot of people, YouTuber, I keep on hearing that, oh, buying metal is bad. Okay, buying construction stock is bad. These are high. Who are you to decide, Baba? Okay, world is dynamic. Okay, it's changing. If you are so expert, then you will not making that presentation. Let's understand. I am coming with a very clear mindset that we have to be flexible. You have to be nimble in this thing, and you have to continuously evolve yourself. It's a very challenging environment. You have to learn a lot. Okay, and also unlearn a lot also. Okay, because you're coming with certain myths, and that is not the way life would be. You have to change. And I don't know, when people make statement of 20 years terminal value. Okay, management of the company doesn't know what will happen in 20 years. And analyst talks about, the money manager talks about. I'm very vocal about it. I'm not a visionary person who can give you 20 years view. Okay. It is actually bizarre to say that 20 years I have a clarity. This is a terminal value of 20 years. Okay, or this is a compounder stories. I'm hearing that. Okay, but it changes. So that's the reason say we are not married with any view or any stock idea. Equity and asset class is long term. Okay, but sector and stocks are not long term. That is something which we have to break. A lot of people say, no, I bought lever and holding. Everybody will not become a lever, and not necessary that everything will remain as it is. Okay, best of the names got wiped out. Okay, so I think the challenge is, it's a mental game. How well you play it. The more you learn, more you adapt new things, the more you will be successful.
Okay. So before finishing, I have only just two questions. One is dollar rupee outlook. A lot of NRIs are there who are thinking, whether to switch money, not whatever, and whether will it go 80 rupees, 90 rupees. Just your take on it.
So I think we have also written in the volatility expansion phase. I talked about between 2020 till 2030, somewhere you will see rupee also moving towards 1992. If I'm not wrong, that's what we have written. But my biases for a stronger rupee is on the higher side. Maybe when events unfolds, okay, like Lehman happened or Corona happened or something, like any event which unfolds, let's say global market crash. Okay, those are specific moments when it has ability to touch those numbers. But my personal view is that emerging market currency as a whole, including India, will actually appreciate. Okay, and dollar index will actually collapse. When we're talking about the relevance of dollar is going to go away, so dollar index has to fall. If not now, down the line, 6 months, 8 months, I expect the relevance of dollar is declining, and DXY itself will be a big problem. Okay, but as I said, that don't anticipate everything happens so fast, so quickly. So we are talking about a 10-year horizon between 2020 to 2030.
Yeah, gradual.
A lot of things change. Okay, so it will be live with volatility. Volatility will remain high, and these things will change. So I don't have a specific answer. Maybe recently, whatever depreciation we have seen, it's going to change now. Okay, we would appreciate. But my larger thesis. So when I'm talking about 10-year thesis between this phase, if I'm bullish on India, I'm bullish on Asia market and emerging market, then I can't be bearish on the currencies. Okay, it's a natural thing. The currency is the first reflection of your economy. Strength in currency. So you can't have a scenario where what China did was keep on depreciating a currency, and that was a very different game that has changed now. Okay, Now, because they were liquidity provider also, India is not a global liquidity provider. Like China became the second largest liquidity provider in global market after US, okay, which is declining now. So I think that game was very different. This perspective is completely different now. And I remain more constructive. Okay, I'm using the word constructive because larger perspective, I'm more bullish on Asia emerging market basket,
Very good.
particularly Asia emerging market.
Sounds good. And with when you are playing with all these numbers, in the rest of the time, what do you do? What are your hobbies, families, interests?
So I have a dog actually, play with her, music is another hobby, and reading global macros, another thing. It's a habit. It's become a passion. So, if there's a change also, it's good to read those things, a lot of things to learn, what we know in India is hardly anything, as compared to developed market or evolved economies. So I think it's a continuous process. We have to learn a lot. True. And we have to actually learn a lot from them.
Sure. True. Anyway, we are coming to an end. That's what you are upright and you answered all the queries that I had, or our viewers, subscribers, now and then they also have these kind of queries. That's what, I am a reflection of their thought process and all those things. Anyway, thank you very much, Sandeep, and good luck to you and your team. You are doing a wonderful job, and Quant Mutual Fund is doing a great job of increasing investors' wealth, retail investors' wealth, because the job that you are kind of doing is mostly for HNIs in general. I'm talking. So that you have brought down, in my opinion, to the retail level, and you are serving them. So that's a great thing, great opportunity for the retail investors to participate in your schemes and grow along with your thought process and your team's thought process. Everyone becomes wealthier and India becomes wealthier. Thank you very much. Nice talking to you.
Thanks, Shukla, and I appreciate that, to sharing that, and I appreciate you share with the retail investor, because the type of work which we do needs a lot of education. New concepts are there, and the retail is an opportunity to learn from us, and maybe you are the best intermediary to provide that analytics. Okay, thanks a lot for your time.
Thank you.